brief introduction of the current speaker. It's very short, that has been given. So, Girish Kaushik is a chartered accountant in practice. He is a partner of JAA and Associates. He stays in Bangalore. Girish is a registered valuer, a CSA graduate, and a CPA. He primarily advises his clients in terms of transaction advisory and valuation. Prior to JAA, he was a KVP Finance at Wipro Limited, where he served in multiple roles: internal audit, business finance, large deals, and M&A. He did his articleship from Deloitte. He lives in Bangalore with his wife and two pretty daughters. And the extra thing that he does is he also handles his agricultural plants, the portfolio of farms that he is having. So now I present before you Mr. Girish on valuation figures across various benchmarks. Thank you, Sir Girish. It's all yours now.
I will try and keep this as, I don't have to try it because the topic is such that it is very factual. So it's available in, if you Google what the valuation figures are under various statutes, there are a number of applications. So I have been constrained to reproduce some of it. So I will try and keep it short. I have to thank Chinmay, it took a couple of minutes. I don't think I have an hour's worth of content. Just in case it gets over before that, I'm happy to take questions. Either on, I will invite Chinmay as well as Anjan. In some of the sessions, earlier sessions, questions can be taken here. This is a pre-lunch session again. That's another reason why I had to finish early. The topic that's been given to me is valuation triggers across various statutes. This topic itself triggers me actually, because the way the laws have been it's like, I used to live in a house which my father constructed over a period of time. So whenever he had money, he would construct one room. What the purpose was, how it fit to the whole house, we had to kind of try and figure out, because there was a room behind a room, why was that room constructed? So some of the valuation related aspects that are coming to various laws is also like that. It's all been in response to a situation. I think many of us thought that once the registered valuer regulations came, once IBBI came into the picture, they'll bring in some kind of sanity into the whole thing, which has not happened, despite nearly 2 terms of current government. I don't know in the 3rd term what they're going to do. They're only creating new and more interesting complications in valuation. Some of that I will try to touch upon. Otherwise it will become very dry. I have tables full of this section creates what valuation trigger. But we will also try and talk about what kind of dichotomy it creates with the other laws. Again, because it relates to various laws, and obviously I am at least not an expert in most of those laws. In case you have questions, you can ask other people. I will try and answer to the extent that I know. So I will not get too much of a definition of what valuation is. Ultimately, I think we're all here, we all understand that it's an exercise to determine the economic worth of an asset or a liability. Very broad definition. There are assumptions, there are limiting conditions. Subject to the data available, it is as on a particular date. Valuation is always an as on date situation. I read somewhere day before yesterday that Oyo Rooms is raising money at $3 billion. At one point of time, they raised money at $10 billion. They, in fact, Oyo is another study in amazing corporate structuring. They had buybacks from the founder. Then the founder invested at a lower valuation. Now they are raising more money at the lowest valuation in the last, let's say, 5 years of their existence. So, if one word answer to that, it's a valuation date. The situation has changed, the investment climate has changed, the way people look at aggregators of rooms has changed, and therefore, you could say that there is some justification why the valuation has changed. One thing that's not there in this is a definition given by the International Valuation Standards Council. What is important for this session, however, is the purpose of the valuation is also extremely important on what that definition of valuation is. What fair market, we use fair market value also as a very loose, common terminology. Various laws have defined fair market value also as per what they want to do. And as far as Income Tax Act is concerned, for example, fair market value is either sub-registrar value for land or NAV value for a building. They completely forget that there is an M in between. Nobody buys at that market. I mean, nobody buys property at subregistrar's value, right? That's not the market value, but they have a substitute because there's a purpose for it. The purpose is anti-avoidance, right? And we'll try and touch upon some of those. Again, since the topic is regulatory, I've tried to combine or compile requirements under Companies Act specifically, FEMA to some extent. SEBI we will try and ignore because one, it falls outside the remit of what I do, what many of us may do. From a valuation perspective, largely it's in the remit of merchant bankers. It's given by local regulations, it's given by SEBI's own regulations. We'll touch upon Income Tax Act and we'll see any other questions that may come up. Of course, the reasons why valuations are done, I've tried to again give a very high level summary. Value discovery. I think one gentleman asked a question, why PPA is done separately and why a buyer doesn't do PPA before buying. And Anjan answered, right, it's gut feel, there may be economic reasons, there's demand and supply, there is irrational exuberance. Why somebody will buy a company's share that has not a single room? I mean, I'm just taking OYO as an example, I have nothing against them. They have no room of their own. All they do is give a software that nobody uses. And OYO, they give a branding, they give some standard operating procedures. Why somebody will value them at $10 billion is because of some kind of an irrational expectation that they can create another Hilton without doing it. The Uber model they try to replicate to everything. Now, when you look at it from that perspective, what PPA will you do? Number one. Number two, he spoke about assembled workforce at length. He also explained assembled workforce is always a part of goodwill. So the thing is, when I acquire an organization, the purpose of why I do the valuation becomes important. In a PPA exercise, I do it for accounting purpose. In accounting, I don't account for assembled workforce or non-compete separately. I value them separately. I need to use it for contributory asset charge, or I need to look at what the useful life of a particular asset is, but I don't recognize it separately. So the purpose of valuation again becomes extremely important. But if you were to really think about valuation as an exercise, ideally you should do it for price discovery or value discovery. None of us do that. I've never done that. So most of the time we are goal seeking to a value that a transaction is occurred. M&A, public offers, investments, securitization. You're offering something as a security for a loan or something like that. You need to value it. Regulatory, of course, we'll touch upon that in a little more detail, so I will not spend time on that in this slide. Accounting requires a lot of valuation. Most of the work that I personally do is related to accounting now, and I'll tell you why also. That's again another reason why I get triggered, because of this regulatory reasons. Fair value of financial instruments. He was talking about allocation of value for CCPS instruments. Some of them have debt characteristics. Some of them have options attached to it. You need to do a valuation and a value allocation before you can actually account for some of these things. ESOP, grant aid valuations, PPA, private and goodwill. Of course, dispute resolution, IBC, all of these have valuation requirements. Because valuation is an activity as on a particular date, subject to limitation of conditions, subject to assumptions, and directly related to the purpose for which you are doing valuation, it becomes important to understand, why you are valuing. If you are valuing for income tax, you will have to think about it only from the perspective of what that gentleman wants, nothing else. Like we were talking about, laws tend to become prescriptive, and for a reason. Laws are always going to be prescriptive, right? It's not like IFRS, it says, I've got a rule-based versus concept-based. Broadly, I want substance over form, do what you want. Law will never say that. Law will give you a form. I should say that. I'll tell you why I should say that in a minute. Income tax specifically gives a prescription, how you should value. They tell you which asset to add, which asset to delete. In their own non-comprehensive manner, they have given that list. You add all taxes, you reduce all taxes, which to reduce, what to do with deferred taxes, what to do with TDS, what to do with advanced tax, why is it not an asset. So they don't care about all. They're given a formula. Regulations are always prescriptive. And why I said, sometimes it is not prescriptive also is because, for example, FEMA said you use internationally accepted valuation principles. What is that internationally accepted valuation principles? There was no definition. Kaushik will cover the Indian Valuation Standards 2018 in this next session. Till that came, till the RV body of work came, nobody realized what internationally accepted valuation methodologies are concerned, are actually about. And every few years, new study will come which will debunk the old study. Why I should not use Black-Scholes method will be a topic of 100,000 different articles, and they are all internationally accepted as long as they have got enough views, right? So, FEMA, for example, is given fairly wide latitude in terms of how you can value. SEBI, however, again has gone into more prescriptive. You do a SEBI-related valuation for a particular M&A activity, for example, a fairness opinion or a swap ratio. They say you have to consider all three methods. Why, Baba? I don't want to consider. No, you have to consider. Then you have to attach a weight to it. It can be zero, but you have to attach a weight. They will force you to think about all three methods. Put a weight to that and average it out. Again, dichotomy. Why I should average out? Why we should cross the river at an average depth of 4 feet? They won't bother because it's prescriptive, right? You average it. You don't give a range. Valuation generally is a range, it's an estimate. But the law will say you compute. So what the law is actually asking us is not a valuation, but it's actually asking you to do a value computation. Right? A computation is different from a valuation. There is lesser latitude for estimation, there is a lesser latitude for discretion or taking your own judgment. Events are different. They tell you when to value, why, how long it can be before that valuation report becomes useless, and you have to take another one. They tell you. Value qualification is also prescribed. Now you start realizing why this topic triggers me. Because they will say you can do this, but you can't do this. For one particular issue, you have to actually start taking valuation reports from 3 different valuers. All of that will start. The purpose is different, and that is the most important thing. Just touch upon it here. As we go into various regulations, we can think about why that purpose could be there. It could be anti-avoidance. All income tax related valuations are always anti-avoidance. They want to ensure that there is a reasonable tax base that is offered. The 50 CA, the 56 to 10, 56 to 7B, all of that are driven by anti-avoidance. They just want to ensure that you pay a minimum amount of tax. Therefore, they have taken a proxy. They have said, you give me sub-registrar value, no problem. As far as 56 to 10 is concerned, if you're selling property, as long as it's a sub-registrar value plus or minus, you're fine, no problem. It doesn't matter that it is very different from the market value. Similarly, as far as FEMA is concerned, it's all exchange control. Simple rule of thumb, right? Foreign exchange is coming into India, asset, which is the value of the company, is going out of India, it has to be fair market value or lower. It doesn't matter what that other country wants, it does not matter. Similarly, if there's an FDI that is coming in, it has to be at value or above the fair market value. That's how the law is defined it. There are a lot more contradictions here. ESOP itself, accounting requires you to value at grant date. Income tax requires you to value at exercise date. Income tax requires a merchant banker to value. It doesn't care about whether you are an RP, whether you are a valuer, whether you are anything else. Whereas Companies Act, the accounting part does not require anybody. There is a interpretation that anything under Companies Act, which includes Section 136 or whatever, the accounting standards and so on, has to be done by a RV. It's a good interpretation for me. I am an RV. I hope I get more business out of it. But there is no. I mean, that's a kind of a nebulous interpretation. Issue of shares. We can spend some time on this in subsequent slides. With all the changes that they have done as far as the Finance Act 2023 is concerned, they have brought in non-residents also into the ambit of 56 to 70, the angel tax issue. And they said that, look, you can only issue shares at a premium for a company in which public are not substantially interested and which is issuing shares at a premium. It can only be at fair market value as determined under rule value or whatever. And there they said accountant can certify only if it is on a NAV basis. Other basis you have to go to a merchant banker to do. And then they brought in non-residents also into that section, which was not there earlier. They've given some relaxations that are all, just consolation price. They said you can use 5 more methods. No problem, merchant banker will use 5 more methods. I have nothing against merchant banker. I'm just saying that for a share issue, I have to take a FEMA valuation report which is issued by a chartered accountant. It can also be issued by a merchant banker. Companies Act has to be by an RV. Income Tax Act can be an accountant, which is a chartered accountant if it is at NAV, or it has to be a merchant banker if it is at a premium and you are using DCF. So for a simple share issue, the company is expected to get 3 reports, which is, I think, the whole reason why this valuation topic. There have been attempts to standardize. It's not that they are not trying to standardize it, but I don't think there's been a cohesive attempt to do it. The whole RV rules, the entire attempt to create an RVO as an organization, a standard setting body, and education, academics attached to various institutes that perform trainings, certifications, was to consolidate. It's achieved very limited purpose. In Indian Valuation Standards 2018 has helped a lot in standardizing from a methodology, report, what should the report contain. Basically, it provides a very good background or a bedrock for us to have our practice on. So, regardless of the valuation statute, I think I at least use valuation standard as a very strong foundation based on which I write the reports. Qualification of valuer is different under valuation for different statutes. We spoke about that. So therefore, any valuation assignment, the valuer has to look at the need for valuation, which is the trigger. Right? Why are we doing the valuation? Under that particular law and statute. For each of that, there is a purpose, and therefore even the law itself may require you to look at things slightly differently, specific law. Methodologies that are prescribed are different. Like I said, in income tax, from a share valuation perspective, they talk about NAV if it is issued by accountant, or any other method. Now they have issued comparable, they've included comparable company methods. They included some 5 or 6, including option pricing methodologies, they've included into the revenue way as far as the merchant bank is issuing it. So each of these impact the valuation date that shall be considered by the valuer. Yes, because even now the way share transfer works is it says that the valuation has to have happened as on the date of the transfer. Valuation for share transfer is still NAV. They don't talk about DCF method. Again, because the purpose is anti-avoidance, they want a minimum. They want the floor price to be determined. But they say you have to determine based on an audited balance sheet as on the date of the transfer. How is it going to happen? We all have to wait for 1st April to do transfer of shares. That's not going to happen. But that's how it is. That's how the law is defined. So we spoke about some of this in the previous slide itself, in terms of who can do valuation and what kind of methodology can be used. I don't know, is it visible? Companies Act only RV can do, internationally accepted valuation methodologies. Valuation standards adopted by any RBO, again speaks about the ideas. FEMA and RBI guidelines. For unlisted equity, chartered accountants or SEBI-registered merchant bankers can do. Listed equity, only merchant bankers can do. Any internationally accepted valuation methodology for that. Income Tax Act, merchant banker or chartered accountant, we spoke about it, we spoke about the methodology as well. SEBI, mostly it's merchant banker, given by SEBI guidelines. IBC, only RVs can do. It goes back to Evaluation Standards 2018. It's explained something. So, any questions so far? I can just take a couple of questions now, because now we get into tables.
Whatever happened to the valuers which was supposed to consolidate all this?
No, I think our Nirmala Sitharaman madam has been going around everywhere asking for votes. We should ask this question. Because, see, the reason I said it triggers me is not just because there is a grey area as far as what we can practice either as RVs or chartered accountants. That is secondary. It's fine. There is money to be made. There is something else to be done. But from a company that's issuing shares, they're completely confused which valuation to take. In fact, I've stopped doing valuations for issue of shares as an RV because it doesn't make any sense. Any client who asks me, I actually direct them to a merchant banker friend of mine, who incidentally has been allowed to be a RV also.
I've seen that actually. I've seen
Sunday Capital, for example, is both an RV and a merchant banker. I don't know how the law is. There are other merchant bankers who have RVs who are associated with them. So they give a consolidated fee code. Because they are merchant bankers and have invested 5 crores in capital, their pricing is also much higher than what we would be able to charge. Right? But why should I ask the client to pay two of us? So to pay me as well as that merchant banker to arrive at the same value. Two people using their brains in discretion, judgment, estimation, risk-free rate, company-specific control premium, this, that, and the other, and we will never agree. It becomes an ego issue. He was talking about it. Right? I spent half my time discussing with auditors on why I have taken a particular assumption. Eventually, they'll all come down and agree, but half the time you spend with it. So we are all pushing. I am personally pushing all RV valuations for issue of shares back to that merchant banker and let them do it happily. No problem. There is a need to consolidate, therefore, and it doesn't stop there. There may be issues which have more than $5 million, etc., where merchant banker anyway has to come. Now, income tax requires a merchant banker, so you might as well ask them to do it. So that valuer bill has to consolidate and say that look, this is the body of valuers. They are trained, they are subject to continuing professional education. They do the best job that they can do. For example, listed company valuations. Why merchant banker only? If it is a listed company, there is a market that is determining the price as long as it's regularly traded. I've seen those reports. They also copy paste, average it out. That's all you can do. There are three. So I'm just saying that I think there is a consolidated need to sit and think about who can do valuation in what methodology and look at it as a body of science that is important for each purpose. That has not happened yet. Any other question, or I can move to the next slide. So Companies Act related valuation, I put the purpose of why Companies Act requires valuation according to my understanding. So there could be much more nuances attached to it. To a large extent, wherever valuation has been described by Companies Act as a requirement, is for shareholder protection, reporting and transparency. Of course, one more anecdote, our government is taking transparency to another level, right? Private limited company data is no more private. Traction has it, I have it, you have it, 100 rupees, anybody can have it. So they know what share issue is happening at what price. They know who is investing, a little bit of venture intelligence in these subscriptions, you can know who is putting in what money at what price and so on and so forth. But the reason why valuation, and including the valuation report you can download, amazing. So everything is available. But I think the purpose of Companies Act require valuation, and we'll see it in the next, see it in this slide. This is an illustrative list. There are probably another 10 sections where valuation is required. You don't have to go into all of them. For example, there is a section for non-cash transactions and issue of shares to directors. We don't have to go into every single one of them because I'm going to essentially read out this paper and I'll share this with you as well. There's a beautiful, so most of this has been taken from a compendium that ICAI RVO published called Calendar of Valuation Triggers under various statutes. So it's an 80-page document that the institute published, very much similar to this presentation, where they say what is the activity, what is the trigger, and when it has to be done. So we don't have to go through each one of them and read it out here. The purpose of Companies Act driving the valuation is always going to be about transparency, protection of minority interests and shareholder interests, and making sure that, so Companies Act has no other requirement, right? It is not bothered about anti-money laundering. It is not bothered about tax avoidance or anti-avoidance or any of those. Companies Act, to my mind, purpose is only about reporting and shareholder protection and stakeholder protection. Let's put it that way. Anybody who's looking at a passive, for example, a debenture holder or a bank, has to understand at what price the company is issuing shares, or how the assets of the company are being distributed, what kind of rights they are agreeing to, and so on and so forth. So this is, we will go through this. As we go through this, we'll realize most of it links back to that purpose. Section 8 company, when it has to be converted into any other type of company, it's quite obvious. Section 8 company has got its own rights and obligations. It's a company that's not limited by shares. There is no allocation of assets that happen. But if it has to be converted to any other type of company, obviously it has to be valued. Assets and liabilities have to be valued before filing for such conversion. When you say before filing for such conversion, before the board meeting in which the company decides to actually go for such conversion, the valuation report is placed in front of it. Private placement, section 62 and related rules. prior to the board approval of a private placement or preferential issue, a valuation report is compulsory by a registered valuer. They are not restricted any, they link it back to valuation standards. So typically DCF, because most of the times these are issued at a high premium, very difficult to get comparables. So valuation methodology, there are some latitude that has been issued, given. Before filing of that return of, along with the return of allotment, anyway it has to be filed. But the timing of the past 4 itself should have a reference to the valuation report and the valuation. So it means that before the company has a board meeting in which the preferential issue is approved, the valuation would have completed. The signature date of the valuation will have completed. The valuation date could be prior to that. In similar lines, wherever shares are in instruments have been issued for consideration other than cash, let's say a sweat equity or intangible property that has been acquired and shares are issued against that, obviously it has to be valued. Let's say you're issuing shares to a technologist who has a patent in his name. You're issuing shares to them for no cash but for that patent. You have to value them. Otherwise, to what extent are the other shareholders getting diluted is nebulous. So therefore, valuation comes into picture under section 39, under section 54 actually. Section 39 is consideration other than cash, services, goods, and so on. Sweat equity, IP know-how, Rule 8.6 and Rule 8.7 speak about it. No very, very detailed guidance is offered in that. Typically, you value the trigger point for that is prior to approval of that issue, similar to any other event under Companies Act. Then the board considers an issue. It has to have the data that it requires to approve that issue at a particular price. And therefore, the trigger event is prior to that board meeting. Determine any bonds, debentures that are secure and therefore not a deposit. Obviously, valuation of the assets that are provided as security is required. We don't do it. Could be inventory, could be plant and machinery, or whatever it is. Obviously, before the issue of such securities. Section 232 requires valuation reports, fairness opinions prior to M&A activity. Again, valuation triggers prior to the board report to the members. But practically speaking, before the board meeting, because the board has first considered that board valuation report and then only recommend it to the members. Once the liquidator is appointed, within 60 days, the liquidator has to file a liquidator's report, and he has to file a valuation report along with that. So under section 281(1)(a, there's a valuation requirement. There's a minority protection. Again, like I said, there's the intention of the act is stakeholder protection. So when shareholders holding more than 90% of the shares want to acquire shares from the minority shareholders, there's a requirement to perform a valuation before the private offer is made. So these are all what I thought is relevant from a Companies Act perspective, because these are events that we see on a more regular basis than other events. I've not covered everything, is all I'm saying. Coming to FEMA, like I alluded to earlier, the whole perspective is on exchange control and making sure that, in my way, the way I see it is the value of the country is not going out for a value that is less than the fair market value. Whether it is overseas direct investment in which the value goes out in the form of cash, there the valuation is at or below the fair market value. Or FDI, where value is coming in form of cash, but value of the asset of the country, the company shares or whatever is going on, there it is at fair market value or above. Conservation of foreign exchange and to some extent anti-money laundering is touched upon here, is what I interpret it as. Any inbound investment activity, whether it's in a listed entity, whether it is in a convertible entity like a compulsory convertible preference share or CCD, any transfer of shares, whether it's a resident to a non-resident or a non-resident to a resident, triggers a valuation unit. These are all driven by master direction on FDI, pricing guidelines. The trigger is at the time of investment and at or above fair market value, as I spoke about. For conversion, at the time of conversion. Wherever there is a transfer of shares, just prior to the transaction date, you need to get the valuation done. In overseas direct investment, there is a master direction on ODI, which needs to be adhered to. At the time of the transaction, you actually file the valuation report along with the ODI forms and go through the authorized deal. Similarly, at the time of a divestment, similarly at the time of a swap of shares, any other RBI related application that you file. Now, the flavor of the season is flip of companies, right? I think PhonePe recently flipped back to India. I know a couple of other unicorns who are flipping back to India from Singapore or anywhere else that they are registered earlier. Obviously, that includes a fairly complicated transaction along with application to RBI for various things. All of that would trigger a valuation report from the Samvaad perspective. Ind AS, again, there is a laundry list of reasons why valuation may be required in the Ind AS. I have not touched all of them. It doesn't make any sense to go through that laundry list. What is extremely relevant for many of us who practice on a more regular basis is 4 or 5 critical valuation points that are required to finalize most of the financial statements today. The requirement is obviously fair valuation from the estimation perspective to include or recorded account balance. Unlisted investments, either through fair value, through P&L or through the OCI. 109 has valuation. 109 has principles for valuation requirements for financial instruments for most of the Ind AS requirements in a fairly detailed manner. Every period end you need to look at it, especially if it's a fair value through P&L. You need to revalue it. You need to flush out the gain or loss on account of that into the P&L. If it's through OCI, in specific circumstances where it is over, again our fair valuation is required. Impairment testing, again self-explanatory. Earlier accounting standards also had impairment testing. Under Ind AS, under 36 period end, you need to have a look at it, or when there's a significant trigger or indication related to impairment, you need to do the impairment testing on the entire cash generation. ESOP and SARS, share-based payments. From an accounting perspective, you account for ESOP at the grant date. Typically, you forget about it. Then you, either it's a proportionate vesting or a regular vesting, and then you amortize that cost over a period of time. But however, wherever there is a performance criteria that impacts that share-based payment, you will need to do a periodic true-up. For example, there could be ESOPs that are either granted with the number of shares that are granted going up or going down, or the exercise price being variable linked to the company's performance, profitability, especially for sakes of compensations and so on, which may require a period remeasurement as well. Business combinations, Chinmay spoke about it in detail. Acquisitions, PPAs, whether it's a slump sale acquisition, whether any form of business combination will have a valuation requirement from an accounting and reporting perspective. We spoke about why income tax has valuation requirements. Of course, every other act that are direct tax in nature, gift tax, earlier wealth tax, all of them had valuation requirements. I remember even when valuation as a field had not been created, I'm talking about, let's say, 15-20 years back when my father used to practice, and when wealth tax was in existence, even then there were valuation methodologies prescribed under the Act. You would value it based on certain criteria that was there in the Wealth Tax Act and use it for your wealth tax returns and tax payments and so on and so forth. So tax determination under the Wealth Tax Act, under any other, from a capital gains perspective possibly, tax determination, anti-avoidance, 56.210, 56.2.7b, all of these are anti-avoidance, 50CA, all of these are anti-avoidance provisions. Transfer pricing, again to ensure that anti-avoidance, that the tax base is not shifted. We spoke about 56.2.7b, unlisted company, issue of shares at a premium. At the time of issue, obviously, the valuation has to be done. There is no requirement for filing it anywhere. But going by what the department did in the last 7-8 years, a lot of assessments were done, a lot of litigation is still ongoing. Though that situation has got a little more stabilized because the rules became clearer and people started complying it in a far more defensible manner. At the time of issue, whatever valuation report you take from a merchant banker should suffice for 56 to 70 as well. Any transfer of shares from a 56 to 10 perspective or 50 CA perspective, you need to do that valuation. It's a valuation establishing a floor, which means the transaction has to happen at or about the fair market value. Both are complementary sections. One addresses the seller, one addresses the buyer from an India avoidance perspective at the time of the transaction. Again, like I said before, it says based on audited results of the company at the date of the transfer. None of that is practical. We have been taking a call that we take the previous audited financial statements. We also do a computation to see what transaction is happening and whether there is a risk of that getting picked up as an undervalued transaction. Transfer pricing from a valuation perspective, for this slide we can limit ourselves to wherever there is an issue of shares to an associated enterprise, how do you support that arm's length price? It does not talk too much about valuation methodology as far as section 92 is concerned. Any valuation report that has substantiated that value of the share issue is sufficient to address the arm's length question. Slump sale fair valuation, 50B has detailed regulations. It has to be either at the value at which the slump sale occur or the pretty much a net asset value at which the transaction has to be recorded. That's required for tax determination as well as anti-avoidance. Tax determination to see whether there is a capital gain on that transaction, or tax avoidance basically establishing the flow. So I've got about 15 minutes, I've got 3-4 more slides. I'll read through this very quickly as I get. Then we can see if we can have some interaction on any of this. It's very tight. I'm also getting a little bored reading this. I must be the first speaker who will put you to sleep before the lunch session. IBC, specific valuation requirements more from a value determination perspective for the purpose of resolution, right? So the resolution plan can't occur unless you've established a floor, you've given the resolution professional a value to work off of and get resolution plans from interested acquirers or buyers and so on and so forth. So the RP, one of the first things the resolution professional is supposed to do is to get to valuation reports to make sure that they know what they're talking about. They have also come in fresh, they have no clue of the company. They are coming fresh, they're supposed to take over pretty much as the de facto CEO of the company and actually facilitate either a turnaround of the company or a sale of the company. So they need to know what they're looking at. So the valuation exercise initially helps them assess that. And it's required by 2 valuation professionals. They can even ask for a third valuation report if the 2 RVs don't agree, which is quite possible. Nobody agrees on judgments so easily. Or if the difference between the 2 valuation reports is extremely significant, then the resolution professional can ask for a third valuation report to make sure that he understands what he is talking about. Similar to Companies Act, liquidation, whenever the liquidator is appointed, they need to do a valuation exercise. Even under voluntary liquidation under the IBC Act also, we need to do a valuation exercise. The other interesting part where valuation comes into picture, again, I don't know who can do this. I think most SFAs have been doing this, of undervalued transactions. Don't know if all of you are familiar with undervalued transactions. Wherever the RP feels that the company which went into the IBC, into a corporate IRP process, has done undervalued transactions to benefit certain people. Just prior, there is a time limit threshold before which they can determine that. Then the RP can call for a valuation of those transactions to ensure that it's at arm's length. It could be purchase of goods, it could be purchase of services, whatever those transactions are, they can call for a valuation of that to review the undervalued transactions. I won't go deep into SEBI. Like I said, I don't practice valuation from a SEBI perspective. But the triggers are listed here. Mostly SEBI related triggers pertain to investor protection and reporting. If you see the valuation triggers that I have listed out also, most of them are NAV reporting in case of listed companies. NAV reporting is there from a SEBI perspective for listed companies as well. I believe they look at it more from a perspective of seeing, if there is any price rigging that's happening in the market, and value of shares is either going up significantly or coming down significantly, then the NAV is something that's totally not in consonance with that value. Activities such as open offers, buyback of shares, activities such as offers to minority stakeholders, all of our strategic buyouts which trigger open offers, all of them trigger a valuation exercise. Conversion of convertible instruments, the conversion price is not determined, will trigger a valuation exercise. Validity of the valuation report. Again, this is something that one of the earlier speakers spoke about, having your understanding with the intermediates. So sometimes authorized dealers say that the valuation report is valid for 90 days from the date of the signature. Sometimes they'll come back and say it's valid from the date of the valuation date. According to me, it should be the valuation date because that's the date on which you did the ascertainment of the value, and if you're doing a transaction, it has to be in reference to that. Companies Act. There's nowhere there's a mention of the validity of the valuation report per se. But generally we assume a 3-month period. 3 to 6 months is a stretch. Generally we assume a 3-month period. FEMA is 90 days from the date of valuation. That's there as part of the regulations itself. Income tax also. Income tax did not really have a validity of valuation report kind of a clause as far as I know. The only thing that's actually come up very recently is on the amendment that they did last year in 5627B, where they brought in foreign shareholders, they gave a lot of relaxations. One of the relaxations they gave as far as 5627B is they said, if you take a valuation report, it's valid for 90 days. So therefore, if you have an issue that closes which has multiple closings, you don't have to keep taking a valuation report as long as the closing is within a 90-day period. SEBI is generally 90 days from the date of valuation. So I tried to cover these statutes. There are other statutes. My partner Suchi gave me a lot of comments about GST and valuation requirements under GST. I took it out, one, because time may be a constraint. Second, more from a security and financial assets valuation perspective. GST related valuations may not really make sense. Many of them are value determination for ascertaining GST value, related party transactions, services given to the company to their employees, and so on and so forth. There are other laws as well which have valuation requirements. Like I said, I have to thank the Institute. It's a beautiful compendium. It's got everything that is there from a valuation triggers perspective. I borrowed heavily from it. Another colleague of mine, Sushma, who helped me prepare this presentation. So I don't have any more slides, but I can take questions. We have another 10 minutes, 6 minutes.
You had mentioned that India's valuations also have to be done by registered valuer. Where does that come in the act?
It does not. So it's a happy interpretation for me if I were to take that, because then I can make a case for an RV doing a valuation for that. But if you were to take a interpretation that's maybe logical also, any valuation under the Act has to be done by the registered valuer. Very clear. Accounting standards come under the Companies Act. India is also comes under the Companies Act. In RV only came.
Logic for maybe is only for CAs and others are for
It's only good questions. There is no logic. I think there, more than logic, I think there is a reason for that. 5627B came into picture as an anti-avoidance. There are a lot of companies that were taking money as investments, companies that are just formed, companies that have very little value or activity, that were taking investments as share capital at very, very high valuations. There is absolutely zero justification. And many members of our professions are also issuing valuation reports left, right, center, justifying that. If I'm not wrong, I mean, just for the sake of within these 4 walls and one of the critical case laws on this relates to a company by YSR Jagan Reddy, where crores and crores of rupees went in as share capital into the companies that he or his family controlled, where there was absolutely no value in that company. Because CS was somewhere complicit, like in the demonetization, the profession took a hit. This was another case where income tax department successfully convinced lawmakers that let's not get CAs to do valuation where there are significant assumptions and projections that are involved. Let them do the NAV because there's a balance sheet, there's no discretion involved. Let the merchant bankers do the projection rate. I don't know why merchant bankers suddenly become very, very competent and unbiased and objective as far as entering reports for premiums are concerned. I don't know how anybody can issue a report for Byju's, for example. So it is a valuation as on date, subject to assumptions and limitations. So there is no logic. So if there is nothing else, thanks a lot for your time in bearing with me and this presentation.
Thank you, Girish, for that presentation. May I call upon the chairman to present the momentum to Girish. We have two more sessions. One is with CA Kaushik on valuation standards. Later that we have a panel discussions with all the so far whoever has spoken as a panel presenter will be there. Panel discussions. So we will break for lunch as of now and we'll reassemble at 2:30.